Feeling lost in the tax jargon jungle, discover the crucial difference between marginal and effective tax rates and learn how they affect your bottom line. Tune in to transform your tax confusion into clarity. This is Arvind Baraganti, and you are watching The Personal Finance Coach. The effective tax rate and marginal tax rate are two related but distinct concepts in taxation. Let's get into the details to understand them better. What is effective tax rate? Let's call it as ETR. It is the average tax rate applied to your total taxable income. It's the total amount of tax you pay divided by your total taxable income. ETR takes into account all the taxes you pay, which is your federal, state, and local taxes. So ETR is equal to total tax liability divided by total taxable income times 100. So let's try to understand this with an example. So let's assume if your total taxable income is say 100,000 and you pay $20,000 as taxes, then ETR would be 20%. So that is 20,000 divided by 100,000 times 100. Now let's try to understand what is marginal tax rate or MTR. It is the tax rate applied to the last dollar of your taxable income. It's the tax rate on the highest tax bracket you are in. MTR is the rate at which your next dollar of income will be taxed. So let's also try to understand this with an example. Let's assume you have a taxable income of 100,000 and the tax brackets are say 10% of the first $20,000, 20% on the income between 20,001 and 50,000, and say 30% is the tax rate on the income between 50,001 and 100,000. So in this example, MTR would be 30%. That's the tax rate on the last dollar of your income. So in this case, it falls under 30%. So MTR would be 30%. Effective tax rate is useful for understanding your overall tax burden, while marginal tax rate is important for deciding whether to take on additional income or make financial decisions that affect your tax liability. Now let's try to understand how does your MTR impact your financial decision making. So let's get into the details. So the first important point is tax efficient investing. So knowing your MTR helps you optimize investment choices. For example, if you are in a high tax bracket or your high MTR bracket, then tax efficient investments like index funds or municipal bonds might be more suitable. Income timing. MTR affects how much tax you will pay on additional income. If you are expecting say bonus or a freelance income, then understand your MTR can help you plan and minimize taxes accordingly. Tax loss harvesting. If you have an investment with losses, selling them to offset gains can reduce the taxes. So MTR helps determine the tax benefits of this strategy. Retirement planning. So MTR impacts how much you will pay on the retirement account withdrawal. So understanding your MTR can inform decisions about Roth IRA conversions or tax efficient withdrawal strategies. Business income. Entrepreneurs and freelancers can use MTR to determine how much tax they will pay on the business income, helping them with pricing and profitability decisions. Tax credits and deductions. MTR affects the value of the tax credits and deductions. If you are in high MTR bracket, deductions like charitable donations or mortgage interest might be more valuable. Financial planning. So MTR influences decisions about buying or selling assets like real estate or investments and can impact after tax returns. Tax optimized savings. So understanding MTR helps you allocate savings to tax efficient accounts such as 401k, IRA, or Roth IRA to minimize taxes. To conclude, understanding your marginal tax rate empowers you to make tax-efficient decisions, optimize investments, and minimize tax liabilities. It's also essential for your effective financial planning and wealth management. Thank you. Thanks for watching my video. For interesting videos on personal finance, please do subscribe to my channel. And if you feel that you learned something new, please like and share. Thank you.